A pipe bursts inside your condo. Water destroys the kitchen, cabinets, flooring, drywall. You call the HOA. They tell you, that's your insurance. You call your insurance. They ask, what does the HOA's master policy cover? Suddenly, you're holding two documents you've never read, the HOA's master policy and your own HO6 policy. And somewhere between the two, there might be a very expensive gap. Today, we're going to show you exactly where that gap is and how to close it before you ever need to. If you own a condo or live under an HOA, this is the video that could save you thousands the day something actually goes wrong. Subscribe to Community Living for practical homeowner education. No drama. Most condo owners assume one policy covers everything. It doesn't. There are usually two separate insurance policies protecting your home. One belongs to the association. One belongs to you. Neither one replaces the other. They're designed to work together. The confusion starts the moment something breaks, and nobody agrees where the association's responsibility ends and yours begins. The HOA's master policy usually protects the building itself and the common areas: the roof, exterior walls, hallways, elevators, the lobby, shared plumbing. That's what your dues help pay for. But not every association buys the same kind of policy. Some stop at the bare walls of your unit. Others include the original fixtures. Some go further and cover upgrades. That means two owners paying similar dues in different buildings can have completely different insurance responsibility inside their own front door, which is exactly why your association's insurance summary matters more than most owners realize. Your HO6 policy usually picks up what the HOA's policy doesn't: your personal belongings, furniture, electronics, clothing, and often the interior finishes like flooring, cabinets, paint, and countertops. It can also include personal liability protection and additional living expenses if your unit becomes temporarily unlivable after a covered loss. Exactly what's included depends on the specific policy you bought, which is why I have HO6 coverage and I have the right HO6 coverage aren't the same sentence. Think of it like building a bridge. The HOA's policy protects one side. Your HO6 protects the other. If those two policies don't actually meet in the middle, the uncovered space in between becomes your responsibility. Not the association's, not your neighbor's. Yours. That's why the cheapest HO6 policy isn't always the smartest one. Here's the part most owners never see coming. Even when the HOA's master policy does cover the damage, the association's deductible can be enormous. Sometimes $25,000, sometimes $50,000. And in some communities, that deductible can be charged back to the unit where the damage started, depending on state law and your governing documents. We made an entire video about exactly this. Can your HOA's insurance leave you with a $40,000 bill? Link is in the description if you want the full breakdown of how that chargeback actually works. Before you assume you're covered, get 4 answers. 1. Ask your board or manager what type of master policy the association carries: bare walls, single entity, or all in. 2. Ask what the master policy's deductible is and whether it can be charged back to individual owners. 3. Ask which parts of your unit the HOA's policy actually insures and whether improvements you've made are included. 4. Take the HOA's insurance summary to your own insurance agent and ask them directly whether your HO6 fills the gap that's left. Those 4 answers will tell you more than any due statement ever will. The goal was never to memorize insurance terms. It's knowing where the HOA's responsibility ends and yours begins, before a pipe burst or a fire forces you to find out the hard way. Subscribe to Community Living for practical homeowner education. No drama. Just the information you need before it becomes expensive. Thanks for watching. We'll see you in the next one.